Today in InvestTalk, we discuss the state of the consumer as credit card debt levels hit an all-time high. Then we discuss the volatility in markets after the Russian nuclear news. Then I answer questions about Meta, Medtronic, Nike, and more. And at the end, I look at how many federal workers Doge could trim.
This is InvestTalk. Independent thinking, shared success.
Now let's touch a bit on our main focus point, and that is about incomes compared to debt. And what's good, based on the numbers, is that incomes are catching up to the debt. Now, a lot of people might see the headlines that the U.S. consumer now owes $1.17 trillion in credit card debt, a record. And I saw this a lot when it passed $1 trillion, a year or two ago. And, a lot of people are up in arms because of that. Oh, we have $1 trillion in credit card debt. But as usual, like anything, it's in context to what can carry that debt. And data suggests that rising debt burdens remain manageable for the typical consumer. Now, still households are squeezed by rising housing costs, especially for lower income consumers. But consumers continue to spend because most people are employed. And if you look at their debt to income ratios, they remain relatively modest, especially if you look at a report from TransUnion. Actually, credit card delinquencies have fallen from 2.43 to 2.34 year over year. And that's because earnings growth has averaged 6.2% per year since the pandemic began, compared to a 4% rise per year in cumulative debt balances. Okay, so overall debt to income ratios have fallen from 86% in 2019 to 82% today, despite credit card balances going up. So disposable income growth is strong. Retail sales are up 0.4% in October. Now that's down from the 0.8% in September, but still relatively robust. And average hourly earnings rose 0.4%, still higher than inflation. In fact, hourly earnings have been higher than inflation since January of last year. And so that means more aggregate disposable income for consumers. And so that's why you don't want to get too up in arms by these headline numbers. You have to understand the nuance and the context.
Stay informed with exclusive insights by subscribing to the KPP Premium newsletter today.
Now let's go take a quick look at the markets today. And it was a mildly, well, it depends on what index you're looking at. You had the S&P up 0.4%, the NASDAQ was up over 1%, but the Dow was actually down 120 points, down about 0.25%. And it was a very interesting day as we started off lower on the back of Russia updating their nuclear doctrine to potentially strike for more reasons than they had before. And obviously that brought some fear into markets. But ultimately, we rallied throughout the day. And this is what I've been kind of saying for a while now, which is market structure likely leads to higher prices, at least into year end, and most likely into the first quarter, and maybe all the way through the first quarter. But ultimately, this is a seasonally strong part of the market, part of the year. And you add on top of that the fact that we're up in this year. And that means those market makers and those that are short options going into year end and into January are likely going to have to roll positions and do things that basically force buying into year end. And so that's what you're typically seeing. And that's why you don't really get much downside follow through on any of these little pullbacks. Now, ultimately, does that mean that you can't have a modest pullback maybe into middle of next month? I think that's always possible, but more of a choppy period than some major drop into year end or anything like that. So that's what we are seeing right now. The earnings season is largely behind us. NVIDIA does come out tomorrow, so that will be a market mover that we'll certainly watch. But after that, you really don't have much in regards to major earnings announcements, and they'll be pretty much through earnings season. So that's where we are at, and we will continue to watch as we head into the holiday season. Remember, we're a week and 2 days away from Thanksgiving, and the holiday season is in full effect.
Hello, I was trying to reach Justin or Luke. I was calling about ticker symbol PSQH. That's PSQ Holdings Incorporated. I've got just a little bit of it. I'm curious, how does this stock look now going forward? Should I be a buyer? Do I need to sell? Interested to get your rundown on this. We love the show. Thanks. Have a great day. Bye.
All right, looking at PSQ Holdings, PSQH, and they operate websites and mobile applications named Public SQ, Public Square. And it says it's an app and website that connects freedom-loving Americans to high-quality businesses that share values both online and local communities. So, it sounds like a website that will connect you with people that have maybe similar values, shall you say, as you. And what's interesting here is it's an interesting name, but it's a terrible business. You have an $80 million market cap, so very, very small, negative profitability, negative cash flow, a lot of debt on its balance sheet, and it just continues to go lower. The technicals are atrocious. Now it's at $2.28. It went public in the 20s, and now it's at $2. And this just shows you that this one's tough, because in many ways you get political with giving an up or down vote on this. So I'm not telling whether this is a good website or not, but it's a terrible business. Okay, it's kind of like DJT, right? Trump's SPAC or Truth Social, whatever. It's very partisan, and frankly, most partisan type of businesses like this are usually not good businesses, and really, this is just simply designed to issue more shares and, steal money basically from John Q. Public. They went public with, 27 million shares outstanding. And in just a year, it's up to 34 million shares outstanding. So that's how they're financing themselves. They're issuing more shares, issuing more debt, and just burning cash. So, yeah, no reason to get involved with this. It's a terrible business. Okay. Thanks for the call. Now, I hope you've been telling your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play, and as well on YouTube. And we get questions over there all the time, and we get questions submitted via the comment section. And Iraq Don says, what are your thoughts for picking up semiconductor HIMX? HIMX. It has been beat down for a while. They don't do high-end chips, automotive related, I think, but at the low $5 level, maybe some good upside. So here's one issue for these low-end chips is that China has been heavily invested in these low-end chips. And so obviously they're trying to find new ways to spur their economy, spur job creation. And they've certainly done this with electric cars. And they're selling a lot of very cheap electric cars all around the world. And what they've also been doing is investing in these low-end chips. Okay. And HIMX, HIMX, makes these type of chips. And I think that's where you're getting this pressure from, is potential Chinese competitors dumping at low prices. And that's why earnings expectations for next year are supposed to fall 14%. And those estimates continue to come down to 36 cents per share from $2.65, which they made back in 2021. So historically, this has been a company that hasn't made a lot of money. You might be chasing that nice 5.3% dividend yield. That's my guess, to be honest with you. But if you look at its payout ratio, it's over 100%, which I don't like. And if you look at the latest dividend, let me pull this up here. Sometimes which websites were a little faster. There we go. Yeah, it's already come down from $1.25 to 29 cents. So that dividend is very volatile. Their profitability is pretty meager. They have a good amount of debt in their balance sheet. The technicals are poor. I just think if you're going to invest in semiconductors, you can find a lot better than this. So it absolutely pass on HIMX. Now let's pivot back to the InvestTalk voice bank for a question that came in earlier.
Hi, good evening. This is Said from Charlotte, North Carolina. I would like to discuss ticker symbol META, Meta Platform. Currently, it is at 554, 4% down today. Do you think, is there any good entry point with this company? If yes, can you please give your guidance? Thank you so much. I will listen to your answer on the next podcast. Thanks. Bye.
All right, looking at meta platforms, this is the old Facebook, right? Facebook and Instagram. We know Facebook as a platform has been, dying for a long period of time, but Instagram remains very, very robust, as well as WhatsApp and use there. So, those are two platforms that continue to drive good engagement, drive good ad revenue, et cetera. And so that's really been that big rebound, right? They went from $13.77 in earnings in 2021 all the way to $8.59 in 2022. And the stock sank as they were investing in the metaverse and changed their name. But they smartly pivoted and slowed down their investment in the metaverse and doubled down on their platforms that are actually working, right? Instagram and WhatsApp. So earnings this year is supposed to be up to $22.65 and $25 next year. So if that follows through, then you're talking about roughly market multiple going forward, and that's not bad. The problem is that revenue growth is starting to slow and expected to continue to slow into next year, into the mid-teens, and earnings by end of next year is supposed to be at 5% revenue growth. So that's my worry here, is that that momentum will slow and the market will find some level of lower multiple to trade at. And if you look at other communication services companies, tech companies, kind of the Mag 7, they're starting to underperform the rest of the market. And so I don't know if this is the best time to be adding to the position. I'd be looking for a time to of more bearishness overall from a sentiment perspective. But the technicals are fine. The valuation is okay. It's not egregiously overvalued, but certainly not cheap at these levels. But price sales at 9.4, that is pretty expensive. So I would pass for now. Keep on your watch list because they do have good platforms that are that remain sticky even with TikTok and as a competitor. So I would just keep on the watch list for now. I wouldn't buy it. Let's go talk to Bob in Mel Brea, California, asking about QS and listening via our podcast. How are you doing, Bob?
Doing good. Yourself?
Yeah. Do you own Quantum-Scape or are you looking to buy it?
I own a little bit of it. I actually was tracking it back when Steve Peasley was on. Best wishes for his whole family and everything. Mm-hmm. But I don't really know beyond just keeping a small portion because I don't want to make it beyond 1% of my whole investment. It's one of those higher risk plays. But I don't really know beyond just waiting long what else I should track beyond this company.
Well, there's nothing really to track here. This is one of those names that Steve was always interested in, and I never thought was a great investment, and she continues to grind lower. It's all about solid state batteries and whether or not they're going to be adopted, and that there's some level of positive economics for this technology. And so far, there hasn't been. It continues to burn capital, lose money. And, many car companies have looked at this technology. They've asked for samples. They've looked at potentially integrating this into new products. But based on the cost compared to the current technology, it just has not been worth it. And so there's really nothing to monitor until there actually comes a real world long-term application. Their revenue is still nothing. And, it's still worth $2.5 billion. And so what do they do? They just issue more shares. It's one of those I call it Ponzi companies that Steve typically didn't like. And he always said, if you're ever going to buy a Quantum-Scape or anything like this, you want to keep it a very small percentage of your portfolio. I'm not a big fan either way. I don't like companies that are just there burning cash, issuing more shares, selling the dream I've seen this too many times in the biotech space. You see this in the technology space in many respects as well. And this is just another one of those. So I would sell it, to be honest with you. But if you want to keep a small portion and you're basically praying for this application to find some economic value here, then go for it. But otherwise, I would sell it.
Thank you.
Thanks for the call. Here comes another live call, this time from Mike in Massachusetts, looking at MDT, Medtronics.
Yeah. Hey, Justin. Thanks for taking my call. I was calling. I got a small position in Medtronic. They reported earnings this morning. Overall, they look good. There was a little supply issue on one of their problems. Sounds like that'll be taken care of. They're saying anyways for, next quarter. So I was calling to see on this little bit of a dip what you think of it, if it's a buy for some more shares.
Yeah, we actually own this for clients. We started picking it up around the summertime in the high 70s. Now it's at 85. It has pulled back from the low 90s back in October. And but overall, yeah, I mean, we think this is still a very, very solid company with a strong balance sheet, good free cash flow, about $5 billion trailing 12 months on a market cap of about $108 billion. So about a 5% free cash flow yield. And what are they doing with all of that cash flow? Well, they are buying back shares, and it's a steady company. And so if you want healthcare exposure, the pharma names are certainly not where you want to be. We much rather be in the medical device companies like Medtronic. For everyone else out there, they make implantable cardiac devices, surgical robotics, insulin pumps, surgical tools, and more. So it's more in the, like I said, in the medical device space, and we much rather invest there than the pharma names. So we like it on this pullback.
Hey guys, my name is Jack. I love the show from Traverse City, Michigan. Just wanted to get your take on an ETF. I like ETFs just because they give you a little more broader exposure to a sector. I think copper, the electrification that we're going to be going through in the next 7-8 years is going to be a pretty dominant sector, if you will, out there. And I was curious on your thoughts of COPX, that's COPX. Thanks for your time. Have a great day. Bye.
All right, looking at Global X Copper Miners ETF, COPX, and we agree. I think this is one of the best ways to play so many secular trends, from EV adoption to upgrading the electrical grid to AI and cloud infrastructure, et cetera. Copper is just needed for moving data, moving electricity all around. And that's the demand. That's just the demand side. That's not even talking about the supply side, which remains relatively limited when it comes to new copper supply coming on market. And so that's why we hold one of the large copper names in our portfolios, a couple of them. And so we really like exposure here. Now, this is a broad-based way to get exposure to these miners. There are 41 equity holdings within this ETF. So you are getting that diversification. The biggest holding is about 5% of the portfolio, and then heads on down from there. And you really have exposure from all over the world: Europe, China, Canada. Let's see where else. Australia. I'm just looking at some of the where the companies are located. Great Britain, etc. So you get worldwide exposure with this name. And let's look at the fee here. Its expense ratio is 65 basis points, though that is pretty high. We'll say that. But this overall, if you're looking for broad-based exposure, you don't want to do the research to find the best within the space. I think this is a fine way to go. Just understand that you are paying a fairly hefty fee at 65 basis points. Thanks for the call. Now, let's touch a bit on the Trump trade. And this is important to understand because we're only, 2 weeks or so since the election. And we see bank prices up, alternative energy stocks are down. And there are a lot of prognostications of what will happen with the administration and what moves will be justified. And we know that some will and some will not. Only time will tell. Just like any incoming administration, there's a lot of hopes and dreams, but when it comes to implementation, that often leads a lot to be desired. Now, there's some long-standing lessons that experienced traders like myself have known, which is that in the short term, there's a lot of noise in markets. But when you look at longer periods, say 6 month, 9 month, a year, especially, and you see consistent continuation of a theme, that is when you will say, okay, that is not just noise, that is something that should be integrated into a portfolio. And it's not clear yet which themes you should be ignoring right now because we're only 2 months into this. And as time goes on, especially through the inauguration, through getting confirmations finished, we'll see a lot more of what Trump does and less of what he says, right? Because what he does is going to be far more important to the durability of any trend. Because markets, equity markets especially, are noisy in the short term, but persistent in the long term. So generally, you want to overweight stocks with decent fundamental momentum, okay, but ignore share price moves over the past month. That's because typically short-term moves are driven by two things, either positioning or news-driven, right? So headlines or, new hot money coming in. But none of those give you an edge. Headlines come and go. We know that. And hot money coming in over a short period of time is just that. It takes persistent money coming in over extended periods of time for trends to emerge. And if you ever have talked to a broker, anybody selling a commission product, oftentimes they will start with a pitch that says something like, the market is changing its view on X, Y, and Z. And ultimately, that is just them trying to spin a narrative. And they're usually using things that are a headline, something that's new, that seems exciting. But what's more exciting are trends, because the trend is your friend. The trend is your friend until the end. But investors tend to look for signal. That's what us investors look for. We want signals. But trading floors, they usually are going for noise. So you have to ask yourself, are you an investor or are you a trader? Investors look for those trends, and so should you. So those people chasing noisy Trump trades, seems like a good time to calm down a little bit and wait for any durable trends to emerge. Now we got time, so let me drop another question from our InvestTalk YouTube channel. Jim Leahy says, I'd like your thoughts on SPNS. SPNS. This is Sapiens International. Wow, this is a name that had a big drop recently. Was around $40 back on the 8th. Now we're down to $27.20. Let me pull up. I'm assuming this had something to do with earnings. And this is a small cap name, $1.5 billion market cap. Israeli developer of software and modernization and enterprise application integration software for the insurance industry. Interesting. SPNS. Okay. Earnings last quarter were 5%. Revenues were up 5%. Earnings are up 9%. But it looks like going forward, earnings expectations are coming down to $1.47 this year and $1.50 next year. And that's the issue, is this was trading at a nice premium when it was trading on $40 per share, and now that's coming back in line. Let me see here. I do like the return on equity around 16%. That's good. Let me zoom in a little bit. And that has remained consistent. Let me pull up its balance sheet. Balance sheet is solid. Free cash flow about 69 million on a $1.3 billion market cap. It's okay, about a 5% free cash flow yield. My issue though is simply the technicals now. The technicals are broken. Let me look at a support level. I'm just going to zoom out here on a weekly chart. Yeah, it is coming up to support around $25 per share. I would definitely wait until then and see if it can hold. If it breaks below that, there's I think more problems to this name. So I would be patient on it until 25, and then I'd have an out below 20, call it 24. And I think that would be a good way to handle the position. Okay. Thanks for the question submitted over on our YouTube channel.
Hi, Justin and Luke. This is Neil from Chicago. Love your show. Been a listener for some time. I had a question about Nike, symbol NKE. What's going on with Nike? I have some in my portfolio. I've been thinking with a little bit of a management change, they're going to start going up and, reverse the trend. But as we speak, every single day for the last several weeks, it's been constantly hitting new lows when the rest of the market is hitting a high. Do you think that trend will reverse? Is it time to just, cut my losses and get out? Do you think the upcoming Thanksgiving and the holiday season will make things turn around? Would love to hear your views on that and listen in on the show. Thank you and have a good day.
All right, looking at Nike NKE. This is a name that we did pick up right around $70 or so, low 70s, and it went all the way up to 90, and now it's back down to around where we bought it, around 73 and change now. So still up a little bit, but this is a name that I think you're going to have a bit of patience with. Why? Because Nike has a wonderful brand, but like a lot of large companies, their management team can lose direction. And I think that's what happened. Now they have a new CEO, but you can't turn around the business in just a quarter or two. It's going to take a little bit of time in order to refocus the business. It's really a design company at this point, and they need to refocus on technology, which I do believe the new CEO, Elliot Hill, is going to do, right? Not just technology and chips and such, but technology for the athlete to help improve athlete performance, really get to the ethos of what Nike was built for. Once again, that's going to take time. And right now, I think you're just getting some malaise as the market still has an indecision of whether that's going to work or not. But like I said, the market tends to be pretty fickle. They tend to want results now. But last quarter, earnings were down 26%, revenues down 10%. I think it was kind of that kitchen sink quarter, especially for a new CEO that wanted to get the crap out. And so it's likely going to look a bit better going forward. But this is more of a longer term turnaround play than something that's going to move tomorrow. This is, I think, a good value from the value of their brand and what the brand could be. But you're going to have some patience with Nike. Thanks for the call. Now let's touch a bit on DOGE, the Department of Government Efficiency. And this is where both Elon and Vivek are expected to advise President-elect Trump on trimming costs in the federal government. But let's take a look at the federal government's employees and how much can really be cut here. Now, what's interesting is it's a good chart going back from the George W. Bush administration through Obama, Trump, first Trump administration, and Biden. What's very interesting is that the last 2 years, they hire a lot of government workers. All of these administrations. The first couple of years, especially the first year, not a whole lot. But as you head into an election, they tend to hire more, right? Why did they do that? Well, they want to juice the economy a little bit to make the economics look better, right? And so that's an interesting little wrinkle that I saw with this chart. But overall, there are 2.3 million Americans working in federal government civilian jobs. Okay, that's about 2% or less than 2% of the total U.S. workforce, and these are nurses in the Veteran Affairs Hospital, park rangers in Yellowstone, federal guards in federal prisons, for example. And roughly 70% of the civilian roles are in military or security-related agencies. So Veterans Affairs have the most civilian jobs, 486,000 employees, mainly talking about hospitals and clinics for veterans. Okay, so how much can really be cut there? Homeland Security, that's now the second largest. I would say there's probably some bloat there, I would imagine. It only created in 2002. And so 22 years on, 23 years on, I'm sure there's a lot of bloat there. But the education department, that's only 4,400 workers. That's the smallest department. So you need to get rid of that. There's not really much there. The Postal Service is self-funded. And, there just isn't a whole lot to trim if you get down to the bare bones. And they don't really make that much money, to be honest with you. Okay, the lowest median salary, $60,000 in the Treasury Department. A lot of clerical jobs there. So, I think there's probably some cutting to be done, but not enough to really change the trajectory of our federal deficit.
Thanks for being here.
If you found this video valuable, please like it and subscribe to our channel for more insights.
Hello, thank you for your podcast. I have found it educational and helpful over the years. I prefer lower risk investments. Most of my investments in fixed income, with a large part of this being in Treasuries, mostly short-term, 3 to 1 year. Because of the debt ceiling, I'm concerned that I have too much exposure in Treasuries if I should be selling some of my Treasuries. Any help or guidance will be helpful. Thank you.
Well, that's hard to really say unless I see your whole portfolio. This is what we do at our portfolio reviews, look at, the exposure to Treasuries compared to, your broader goals, risk tolerance level. You say you're relatively conservative. This is something we try to balance out with our clients now, is that so many people have PTSD from '08. They think this big deflationary bust is going to happen again. And, to us, it's pretty clear that governments are not going to allow that. They're going to spend. They're going to create accommodations. The Fed and Treasury are going to create an alphabet soup of programs in order to paper over any issues like the Silicon Valley Bank crisis, et cetera. And really the risk is actually to the upside, meaning inflationary upward spiral versus some sort of big deflationary downward spiral like '08. Okay. And so when you're in Treasuries and very conservative investments, you have a risk of inflation eating away at your overall return. So there's certainly some balance that needs to be had there. Now, it's not saying you go Treasuries all the way to equities, but do you take a step up in risk to corporate bonds, for example, and get a little bit extra yield and try to get above that inflation rate? These are discussions to be had. Now, I like that you're focused, at least when you're buying Treasuries in the shorter term, right? 1 to 3 years. Now, 3 years is creeping into the intermediate term, but you're not buying 10, 15, 20-year Treasuries, right? So that's certainly a positive. So I like that you're thinking about this, but this is a better discussion more for portfolio review, and that's why I encourage you to head over to InvestTalk and schedule one of those. Now, let's tackle one last question from our InvestTalk YouTube channel. Jim Leahy again asks, TTEK had a large pullback today and is on my watch list. What do you think? Is it a buy, and where it is right now? All right, looking at TTEK is the symbol. It did move down from around $50 per share just a couple of weeks ago. Now we're at $40 and change. So a nice 20% pullback here. They provide consulting and engineering services focusing on water resources management and infrastructure projects. Obviously a need in this country. And I'm sure that the Trump administration will likely focus on these type of infrastructure projects versus, say, green energy projects like the Inflation Reduction Act and the CHIPS Act, et cetera. So I could see why this might be on your watch list. It does continue to earn more money each and every year, and 53 cents back in 2018. This year is supposed to make $1.26 and $1.47 next year, $1.68 the following year, and it's a $40 stock. But if you're going based on forward-looking earnings, it's still a mid-20s multiple, and growth is slowing. Revenue growth was 9% last quarter, and revenue growth a year ago was in the 40% level, right? And expectations for next year's and the year after earnings continue to come down. And so this to me just broke technically, and you need to zoom out here and find the support level. Now, it definitely doesn't have any decent support till about 38. Now we're at 40 and change now, so that's not too far from here. But let me give you a better number. I'm going to say $32. Low 30s, that's where I'd pick up TTEK. Not yet. The technicals just broke. It is at some decent support here, but really the major support comes in around 32. Thanks for the question. And for everyone out there, don't be afraid. Head over to our YouTube channel. Check us out. Look at my charts. Look at my face as well as Luke, and see what we have to say over there, and ask questions via the comment section as well. Now that about does it. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And I hope you've heard that InvestTalk podcast is also available in video form. So once again, head over to our YouTube channel to search InvestTalk with 2 T's. Remember, we can help you better understand your portfolio dynamics and calculate your risk number by just going over to investtalk.com, clicking on the portfolio review button. This is a free and confidential service. And if you haven't optimized your 401k, we can help you as well over there. Just start at investtalk.com. Independent thinking, shared success. It's InvestTalk. Good night.